here from Bounce Financial. Today I'm going to do a webinar on a presentation that we like giving here at Bounce Financial about how different investments suit different goals. When it comes to the world of investing, what we're looking for is the investment that suits you personally. Generally, you don't want advice that just says, here's the best and the hottest investment. You want an investment that suits you personally. And the next logical question is, how do I know what investment suits me? So this presentation will go for about 30 minutes, and I'll run through the different types of investments and the different types of the ways you would spend those investments. So I'll just minimize myself here and we'll start working through it. If you have any questions, obviously reach out to us. We'll be able to talk you through them. So let's make myself a little bit smaller. There we go. Okay, so how do you identify what investment suits a different goal? Okay, before we get into it, I'll just give a bit of a brief background about Bounce Financial and what we do. So Bounce Financial is a company that was set up by my wife and I. We specialize in financial advice for younger professionals that are going through life's big transitions. So, you know, if you're doing things like you're buying houses, you're having kids, you're starting to invest, you know, you're making good money, but you're not sure what to do with it, that's where we really step in. We think that we're best suited to this because there's a lot of financial advice out there, but it's geared towards retirees. And whilst we think retirement is really, really important, we also understand for a lot of our clients, they're facing, you know, another 30 years before they retire. And we really want to have those conversations about how do we grow our wealth to prepare for that. And this is how, I guess, investments work in that space. Now, just a quick disclaimer. For those of you who know me, I used to be a lawyer, so always got to have a disclaimer. Obviously, this is just general advice. You're going to need to apply this to your particular circumstances. This is about actually picking investments that suit your particular circumstances. So bear that in mind when you're thinking about how you're going to apply this, and obviously seek advice from a professional, hopefully me. Okay, so let's move on. Okay, so what is the best investment? Great question, something that people ask me all the time. And you should just Google it. Just Google what the best investment is. If there was a best investment out there, if there was a single best investment, I would close up shop. I would simply put up a website that says this is what you should invest in and have a great life. But unfortunately, it doesn't work that way. Different investments suit different goals and different people, and figuring out which ones suit you and which ones suit your goals as they change is really, really important and can be a bit difficult. And so what I'll do today is I'll run through, I guess, how we approach the problem of identifying what investments suit your goals. Okay, so moving forward, the next question I get after what is the best investment is, should I invest in shares or an investment property? Great question. It's starting to, I guess, wonder where the investments are, but I think what we're doing is we're going too much to the actual approach we're going to take, right? We need to start more high level. We need to start to think about what are we trying to achieve. When it comes to shares or an investment property, it's also key that these are not the only two options, right? I think the world of shares or investment property is actually a very small portion of the investment world. There are lots of different types of investments, and really the best investments are the ones that use a combination of many things to achieve your goal, right? Anyway, I will move forward and we'll talk about this in a second. Okay, so if shares and investment properties aren't the only investments, what other types of investments are there? You know, like people know about homes, they know about buying investment properties. Shares I have a brief understanding of, but what else would be out there that you could potentially invest in? And I've included a list here of some of the investments that you can invest in and some of the stuff that we do invest in for our clients, right? So you have residential investment properties, which is, you know, buying a house for someone to live in and renting it to them. That's pretty common. Commercial property. So businesses need to rent property, and commercial property is something that you can buy whether you buy the whole commercial property and rent it to a business, or whether you are involved in what's called a unit trust. So you pool your money with another group of people and they invest in the property. There are a lot of options in that space. Now, when it comes to shares, if you don't know what a share is essentially buying a small portion of a company. So if you have shares in Qantas, you are actually a very small owner of Qantas as a brand, right? Shares, obviously there's a lot of companies. There's companies in Australia, so there's Australian shares. There's companies all over the world, so you can buy companies in other countries. So, you know, for a lot of people who are interested in tech, so things like Facebook, Google, things like that, there's obviously the option to buy shares in the US. And generally buying companies from different countries makes a lot of sense, because that way you get a good exposure to many different types of industries. You know, in Australia, our tech industry is perhaps not as advanced as the US. So by buying from both, you can really get that great exposure. Another type of investment is what's called fixed interest. So fixed interest is basically loaning money to someone and they pay you a set interest amount. So you can get fixed interest for Australian, you can get fixed interest for international. You can have your money in cash. So, you know, cash could be simply a bank account. Cash could be another form of investment where it's invested in cash. There are actually a lot of options in this space, which is quite interesting. And then there is what's called alternatives. So that's sort of the things that don't really fit these other things. And, you know, like an example of an alternative is currency. So, you know, investing in different currencies and things like that. So that's loosely just some of the investment types that exist. There are a lot out there. And it is through a combination of many of these that you can perhaps achieve the goal you want to achieve. And I'll talk through how that works. Cool. Okay, so there is a bit of a view of, you know, should I go down the residential investment property path, or should I go down the investment portfolio path? Now, the reason I separate these two out is generally if you're going to invest in a residential investment property, it takes up a large portion of your investment potential, right? So you don't necessarily have the opportunity to invest in a lot of other things. Whereas in an investment portfolio, you can invest in a number of those different assets that we talked about. So the fixed interest, the shares, alternatives, things like that. But I'll talk through each type and where I think a residential investment property really suits people and where I think investment portfolios really suit people. So let's talk about residential investment properties first, because I think that that's the one people tend to get the most excited about. It's the one people tell me they understand. So hopefully that'll give a bit of, we'll be able to explain it well. Okay, so to invest in a residential investment property, what you're doing is you are taking charge of your investment, right? So there's a number of things I like to point out when you're investing in residential investment properties that need to be considered. So the first is expertise. Now, everyone tells me that they don't understand investment portfolios, and that's fair. That's, you know, something you're probably not familiar with, but they understand property. They know property. And I really have to question that sometimes, because just because you've lived in a house doesn't mean you understand what a great investment is, right? We've all had haircuts. Doesn't mean we're immediately going to make great hairdressers if we ever decided to give that a go. Investing in residential property is a skill, and there are professional buyer's agents out there who spend their life trying to understand how to become an excellent property investor. So if you're looking to invest in investment properties, you can't just buy something that you think is good. You need to have the expertise to understand why it's a good investment. And when considering that, what we're looking at is things like how it's going to appeal to people, how it's going to appeal to people that fit within that demographic. So, you know, you may buy a really lovely apartment, but if it doesn't, like if it's too expensive and it's geared towards students, it's not going to work. So understanding, I guess, what the market is, what the need is for an investment property, and picking the right one, very, very important. When you invest in property, you are putting all your eggs in one basket. You are putting all of your investment money into this one thing that you picked. So it is very important that you get it right. So yeah, that's the thing I like to raise with investment properties. Let's focus on expertise. The second thing I like to talk about with investment properties is something I like to call you can't sell a bedroom. So, people invest for a number of reasons, right? So you may be investing because you want to retire early. You may be investing because you want to have enough money to send your kids to private high school. You may be investing for other reasons. And not all investment types suit residential investment properties. So, once you've bought a residential investment property, when you need to get that money out of it, you need to sell the whole thing. You can't just sell a small portion. You can't just sell a bedroom, get a portion of it and keep investing. So where residential investment properties really suit is if you want a longer term investment where you're happy to have that capital tied up. So things like investing for children's education. Generally, residential investment properties don't suit that type of investment. And the reason being is, each year you're going to have to pull money out to pay for those school fees, but you don't want to pull out the entire investment in grade 8, right? Otherwise, you're not earning money during those 5 years of them, proceeding through to year 12. So the key is the type of investment that suits a residential investment property is one where you're happy to have it all tied up. You're looking really long term. Things like, I want to retire early. Perhaps that's a better investment reason to buy a residential investment property. The third thing I like to raise when it comes to investment properties is they're a high risk investment, right? I think people talk about property like it's this safe investment, but in terms of risk, in the investment world, when we talk about risk, we're not always talking about the risk of your money disappearing, right? Your money can disappear, obviously, if you invest in a super high risk, dangerous thing, right? But largely when we're talking about risk, we're talking about the risk of your money going down in value or going backwards. And when it comes to investment properties, it's actually, there's a relatively high risk they will go back in value. We've seen it a lot with a lot of our clients that have bought apartments in Brisbane, or they've bought homes in mining towns. Sometimes they've gone back $100,000, $200,000, $300,000. So it's very important that you understand that buying an investment property is a very serious decision, and it's something that needs to be taken quite seriously. Now, the thing about investment properties too is you borrow to invest. And the thing about borrowing to invest is in the investment world, it's called gearing. You have the opportunity of magnifying your gain. So if you borrow to invest and it goes up in value, you're actually getting more return than you would if you'd never borrowed. But if it goes down in value, you magnify your losses. So those sort of $100,000, $200,000 losses, they happen because you are borrowing for that. So very, very serious investment and something that we need to think about. You can't just buy a place because it's on your street and you saw it for sale and it seemed like a great idea. It really needs to be thought out. Cool. All right. So I touched on this a bit in the previous slide, but this slide sort of explains when should you buy an investment property, right? So these are the examples of where I think someone should buy an investment property and where it suits. I've come across, I guess, very stern on the idea of an investment property, but it's more because I really want to instill in people that this is a very important decision. It's something not to be taken lightly, but there are circumstances where it suits really well. And we like working with our clients who are investing in property, who understand what they're doing and that are growing their wealth that way. So the first thing is they have the expertise. If you don't have the expertise, then you should be engaging a buyer's agent if you're going to go down this path. Now, a lot of objections to buyer's agents are that they're too expensive, right? A good independent buyer's agent is, not cheap because they have to do a lot of work. They have to drive around to different houses. They have to look at, the different variables that are going to make a good investment. They cost a bit of money. But if you're going to invest $600,000, $700,000 and completely gamble your future success on this, then that sort of fee is very much well worth it. So expertise, either you have it or you're willing to pay for it. The second is that you like to be hands-on. So having an investment property is, it's not super easy, right? Like you've got to deal with tenants. You've got to accept the fact that there will be periods where it's not rented out. You've got to deal with real estate property agents. It's a very hands-on investment, and there are other ways to invest that aren't so hands-on. For this, you need to have a bit of passion, right? Like you need to be passionate about it. If you're not, it's probably not a great investment strategy for you. Like if you want to focus on your life and not be thinking about your investment regularly, then property is probably not the right one. But if you're into it and you want to talk about it and you want to be part of it, then that's great. That's where it really suits. The third is a high risk tolerance. So like I said, when you're investing in property, you are betting everything on one asset, on one investment. So you really run the risk that might not go up in value. You never know what's going to happen. That particular house, the council could decide they're going to extend the road outside of it and make it a major road. Or, like anything can happen that would cause it to go down in value. And, you're not diversified, you can't sort of address it. So what you are chasing from a property is relatively high returns to justify that risk. And to do that, you need to be somewhat sophisticated and, view it purely through the lens of, is this an investment or a good investment or a bad investment? Not, you don't want to be combining things like, oh, one day we'll live there, or, maybe my sister will move in at some point. Like we really don't want to combine personal feelings and investment decisions, right? We want to try and keep them separate if we can. The final thing you should be looking for, like that would suit somebody who wants to invest in property, is you don't need the capital in the short term. So, you're happy to set and forget. You're happy for the rent to pay off the bills on it. You may have to chip in addition on top of that, but you don't need that money in the short term. You really want it to be a long-term investment because the cost of getting into investment properties is high and the cost of getting out is high. I think I saw a figure that suggested it's about 8% of the cost of the house is spent just on buying and selling it. So really you want to see some value over the long term to justify those costs. So this is loosely what I would be looking for somebody who wants to invest in property. Okay, so let's talk about investment portfolios, because that's the other option you can go down if you choose that. If you look at it and go, okay, maybe investment properties aren't for me. Maybe I'm looking for a less hands-on approach. Now, investment portfolios aren't just one sort of type of investment, right? They're broken up into a number of different investments, and loosely it's sort of described as this. So cash, Australian shares, international shares, property and infrastructure, fixed interest, and alternatives and emerging markets, right? I talked about these before. I won't go into detail again. It's all very complex. There's a lot to that, and I could talk about that for hours, but I'll move on. But the point is, it is through investing in different variations of these different types of assets that allow you to tailor your investment portfolio to suit your needs. And I'll talk about that in future slides. Okay, so asset allocation. So we talked about what an investment portfolio is made up of. How much you select of each one of these, that is referred to as asset allocation. I'll just move my little head there. Let's move it up to there. Okay, so here is an example of different asset allocations and how they suit different investment timeframes. Okay, so the first is, I'll use my mouse here, is the high growth. So this is for somebody who is looking to invest over the long term and is looking to achieve the most growth they can get out of this asset allocation, right? And so you can see, for example, there is a large exposure to international shares. And I took these from a product that exists at the moment. I won't name the product because it doesn't really matter. Largely, they're all very similar in the way they do it, but the way they manage this is by having different exposures to different assets. So here's the international shares, here's the Australian shares. So these are very growth orientated alternatives. And then when we start talking about things that are defensively orientated, so Australian bonds and cash, they're a bit smaller. Now, in this example, cash is actually is higher than normal. I think the investment I selected is actively managed, so it's like it's holding a bit more cash because it's buying and selling things quite regularly. But the key is this one is looking to achieve a 4.5% return, so very high return after CPI. So CPI is how much things go up every year anyway. So like your electricity bill and your groceries and stuff kind of go up about 2 to 3% a year anyway. What they're looking to do is match that, but also exceed it by 4.5%. And they aim to do that over a 9-year period. So generally, the higher the growth you want from your investment portfolio, the longer the period you want to invest. Because, and we'll talk about this, there's a bit of variability in it. The asset allocation of a balanced portfolio. So that's one that's got a lot of exposure to those shares and those high growth assets that we talked about, but a bit more exposure to the defensive assets, so the bonds and things like that. So this one, for example, they're aiming to receive 2.5% after CPI. So lesser amount, but it's over 5-year periods. So they're looking for not as great returns, but it's a shorter period that they're trying to achieve that. Now, when we say 4.5%, we're meaning every year. So it's not like after 9 years, it's only made 4.5%. It's 4.5% every single year, which adds up to be quite a lot, as you can imagine. Balanced, a little bit less, but a shorter time period. Now, looking at the asset allocation of what's called a conservative one, so one that's looking at shorter periods, say you're only going to invest for 2 years, it has a strong exposure to cash, it has a strong exposure to bonds and things like that, and very little is going to those shares and those higher growth investments. And again, it's only looking to achieve 0.75% after CPI. So the key from this is by managing these different exposure to different assets, you can tailor an investment to suit what you want to do. So if you say, I need my money in 2 years, I'm going to buy a family home, I would like to have the money aside for 2 years, but I'm comfortable to invest, then perhaps a conservative one suits you. It won't have as great a returns as the higher growth, but it will mean that over the 2-year period, hopefully you'll achieve what you want to achieve. Whereas if you put it all into high growth, because it hasn't done that 9-year cycle, it may not have achieved what you wanted to, and it may have gone backwards. So just a brief sort of explanation of asset allocation. Okay, so let's talk about, I guess, why those different asset allocations suit different types of investment. So this is it's just a visual demonstration of what a high growth investment value looks like. Because you're investing over the long term, and I think in the example I was talking about 9 years, but sometimes they're 7 as well, so I put 7 there. The reason they recommend investing over the long term is because higher growth stuff is the most volatile, i.e. it just goes up and down a lot. So looking at this graph, it might start here and then you check it the next day and it's dropped down, and then you check it the next day and it's gone back up, and you check it the next day and it's dropped down again. And this is how high growth investments work. They move all over the shop, and it can be unnerving. But the overall goal is that they will rise the most over that sort of 7 to 9 year period because they've got the most growth there. But if you're investing in a high growth investment, if you needed the money and you're trying to access it when it's down here, when it's low, then you can't pull that money out, right? Because otherwise you're just going to lose money. You've got to wait until it gets back up here before you start pulling your money out. So that's why you're looking for a longer time frame. If you had a shorter time frame, you're going to have to look at different types of investments, and I'll talk through that in the next slide. Okay, so here's a balanced one. So remember, high growth is all over the shop. Just remember that being up and down. Okay, when it comes to a balanced investment, yes, there is the up and down volatility, but it shouldn't be as much as a high growth investment. And the reason it doesn't go up and down so much is because it has more exposure to what's called defensive assets. So things like bonds and stuff that don't really follow that same path. As you can appreciate, companies go up and down in value. Like one day they look like a really great investment, then other days it's like, well, I don't know how they're going to do. And they sort of go up and down because they're traded every day. You measure them every day. So balance is really good if you're looking at a time frame that's not super long. You're looking sort of about 5-6 years. A balanced investment is a great way to achieve some good returns, but at the same time, it means that when you do need to pull your money out, hopefully, it's at a more stable pace, right? It's not going to go down as far as perhaps a high growth investment. Moving to a conservative investment, this is what we would expect to see. Now, these graphs are just sort of examples. They're not accurate. But what they're meant to show is essentially the sort of up and down swing you would expect from something like this. So, high growth, I expect lots of up and down. It's a very wild ride. Balance, I'd expect a little bit, but not as much. But conservative, I would hope that it would be a little bit more, we wouldn't get as much up and down. Now, overall, because they don't go up and down as much, you can't expect as greater returns from them. So they suit shorter term investments, right? That's where we want to be. All right, moving forward. Okay, so what are the steps in investing in an investment portfolio? Okay, so the first thing we like to do with our clients is identify the investment time frame. So we need to understand what you want to spend the money on, right? A lot of people say, oh, I just want to invest. It's like, okay, but what do you want to spend it on? And it's okay not to have 100% certainty. You might just be like, well, I'm just saving it for a rainy day, right? If your rainy day is years away, like if you've got money set aside for things that come up, say your car breaks down, you've got money set aside for that, then your rainy day is perhaps not for a number of years. However, if you're setting it aside and you're like, I may need to access this in a month, then a longer term investment's not going to suit you, right? So we try to loosely understand your goals so we can identify the time frame. Once we've decided the time frame, we decide on an initial contribution and how much you're going to contribute. The best investments are the ones where you contribute regularly, particularly with that high growth where we talked about where it's going up and down, up and down. You want to be buying, like regularly contributing throughout that whole process, because when it does this downward mark, you want to keep buying because you're getting it cheaper than you normally would. As it goes up, yes, it gets more expensive, but you're following the market. And if you look at the historical averages of the market, it has gone up over time. That's the goal. So understanding, I guess, how much you can put in to begin with, how much you can afford to put in monthly or fortnightly or however you choose to contribute to your investment portfolio, and making sure that the amount you're contributing is money that you're happy to set aside and you're not going to need prior to what was the identified time frame. Now, once you've set that up, then what you've got to do is monitor the performance and adjust. So for us, we look at our clients' investment portfolios. We track how they're going against similar portfolios, if they were made up of similar things. And if they're not performing in line with what we would expect, then we start asking questions. We start trying to find out why that's not happening, and we adjust if we need to. But that's loosely how we go about investing in an investment portfolio for our clients. I guess it brings me to the question, which is best, investment properties or investment portfolios, right? And I put the taco girl, why not both? It really doesn't, it matters obviously, but for me, I'm impartial about the type of investment you choose, right? What we want to do is we want to pick the investment that suits you the best. So if you tell me, look, we need this money in 3 years or 4 years, because we're using it for this purpose, then we'll pick the investment that suits that. If you tell me that you have a passion for property investment and you have a long-term goal and you're happy to take on this risk, then we start working towards investment properties. We have clients that do both. So we have clients that have an investment property, but we've also got an investment portfolio. It really depends on you and what you're trying to achieve. And then, as your goals change, is it flexible enough to fit with your goals, right? So for somebody who perhaps is happy to put the money aside for a very long time, but then, their life may change in the next couple of years. They're talking about moving, they may get married, then perhaps setting it up in such a way that it means you're a bit more flexible. Maybe you sacrifice a little bit in the return space so you can be a bit more flexible. That's generally worth it. Like I said, we don't have a favorite type of investment. The best investment in my mind is the one that's making you money. That's all I care about. You know, people get caught up in the emotion of buying a beautiful home that they want to live in. You're not going to be living in it. It doesn't matter. What you want to do is make an investment that earns money. Awesome. Okay, well, thank you for attending my webinar today. I think I've probably gone about 30 minutes now. If you have any questions, please get in touch. I am available in a number of places. So if you want to send me an email, my email is ben@bouncefinancial.com.au. I'm quite active on LinkedIn as well if you want to connect there, if you're a bit of a business professional. And we also have Instagram. So we try and put out a bit of information on our Instagram. We put you know, different videos of us explaining different investment concepts or different things. So that's a good opportunity to sort of keep in touch with us in a bit of a low touch way. If you have any questions, please reach out. I'm Ben Brett from Bounce Financial, and thank you, everyone. Have a great day.